Chapter 4 National Income How It is Spent. In this chapter, we're shifting our attention to the demand side of the economy, what drives the total demand for goods and services in a given period. The demand side of GDP is made up of four major components, that is, consumption C, investment I, government expenditures G, and net exports NX. Let's begin with the largest part, consumption C. Households receive income from two main sources, labor and ownership of capital. From that income, they pay taxes to the government. What remains is disposable income, or Y minus T, which they can either consume or save. We model this with a simple consumption function. C is a function of Y minus T, which tells us that consumption increases with disposable income. A key concept here is the marginal propensity to consume, MPC. That is how much consumption rises when disposable income increases by $1. MPC equals delta C over delta Y minus T. The higher the MPC, the more households tend to consume out of each additional dollar of income. This graph shows the consumption function relating consumption C to disposable income Y minus T. The slope is the marginal propensity to consume, MPC, showing how much consumption rises when income increases by 1 unit. The straight line implies a constant MPC. As income rises, consumption increases, but not by the full amount. Some is saved. Let's now delve further to investment I. Investment depends on the real interest rate R. Think of R as the cost of borrowing money, or the opportunity cost of using your own funds for investment purposes. I is a function of R. This means that as the real interest rate increases, the cost of investment goes up, and firms invest less. So investment is negatively related to the real interest rate. Now refer to the graph here. It shows a downward sloping investment function. This visual illustrates that a higher R leads to a lower quantity of investment. The graph illustrates the investment function, which shows how investment responds to changes in the real interest rate R. The curve is downward sloping, indicating that as R increases, the cost of borrowing rises. As a result, firms reduce their investment spending, so the quantity of investment I decreases. Next, let's talk about government expenditures G. Government spending refers to the purchases of goods and services by federal, state, and local governments. However, we exclude transfer payments such as Social Security or unemployment insurance benefits. These are not payments for goods or services, they are income redistributions. In our model, we assume that both government spending and taxes are exogenous. That means they are fixed and determined outside the model. G equals G bar, T equals T bar. In this section, let's now look at how the goods and services market reaches equilibrium. First, we define aggregate demand as the total planned spending in the economy. Consumption function of Y bar minus T bar plus investment function of R plus G bar. This includes consumption as a function of disposable income, investment as a function of real interest rates, and exogenous government spending. Next, we consider aggregate supply, which in the long run is fixed and determined by the production function. Y bar is a function of K bar and L bar. The condition for equilibrium in a goods market is when total demand equals total supply. So Y bar equals consumption function of Y bar minus T bar plus investment function of R plus G bar. Here, the real interest rate R plays a crucial role. It adjusts to ensure that planned spending demand matches the total output supply. If demand is too high, R will rise to reduce investment. If demand is too low, R will fall to encourage investment. Let's now examine the loan funds market, where saving is channeled into investment. The demand for loan funds comes primarily from investment. Firms borrow to finance capital spending such as equipment, buildings, and infrastructure. Consumers may also borrow, for instance, to purchase new homes. The key idea is that investment depends negatively on the real interest rate R because R represents the cost of borrowing. The supply of loan funds comes from saving. Households save by depositing money into banks or purchasing bonds and other financial assets. The government may also save if it collects more in taxes than it spends. This surplus contributes to national saving. The intersection between these two forces, investment demand and saving supply, determines the equilibrium of real interest rate in the economy. This graph illustrates the equilibrium in the loan funds market. On the vertical axis, we have the real interest rate R. On the horizontal axis, we measure both investment I and saving S. The downward sloping curve represents investment demand, which decreases as R increases, since higher interest rates make borrowing more expensive. The vertical line represents saving, denoted by S bar. In this model, saving is fixed, exogenous to the interest rate. The equilibrium interest rate is determined at the point where investment demand equals saving supply. This is where the two curves intersect. This intersection gives us the interest rate that clears the market, ensuring that the amount of savings supplied equals the amount firms want to invest. Let's now walk through how savings relate to investment using the national income accounts. First, let's define the different components of saving. Private saving is the income Y that households have left after paying taxes T and consumption C. Private saving equals Y minus T minus C. Public saving is what the government saves after their spending G. Public saving equals T minus G. Therefore, total or national saving is S equals private saving plus public saving equals Y minus T minus C plus T minus G. That equals to Y minus C minus G. Now recall the national income identity for a closed economy. Y equals C plus I plus G. Subtracting C and G from both sides gives us Y minus C minus G equals I. So S equals to I. This tells us that in equilibrium, saving equals investment. Let's now substitute fixed values for output, government spending, and taxes. So Y bar minus consumption, a function of Y bar minus T bar minus G bar equals investment, a function of R, which simplifies to S bar equals investment, a function of R. So the real interest rate R adjusts to ensure that national saving equals investment. Let's consider how changes in various economic variables affect national saving. Assume labor increases by 1 unit and capital remains fixed. Delta L equals to 1, delta K equals to 0. Then MPL equals delta Y over delta L. Also remember that delta Y minus T equals delta Y minus delta T. So the change in consumption is delta C equals MPC times delta Y minus delta T. That equals to MPC times delta Y minus MPC times delta T. Let's work through an example. Suppose MPC equals 0.8, MPL equals 20. For each of the following scenarios, compute the change in saving, delta S. We start from the formula delta S equals delta Y minus delta C minus delta G. Using the consumption function, C is a function of Y minus T, and MPC equals 0.8. So delta C equals 0.8 times delta Y minus delta T. Substitute into the saving equation, delta S equals delta Y minus 0.8 times delta Y minus delta T minus delta G. That equals to 0.2 delta Y plus 0.8 delta T minus delta G. Now compute delta S under different scenarios. A. Delta G equals 100. Delta Y equals delta T equals 0. Then delta S equals 0.2 times 0 plus 0.8 times 0 minus 100 equals negative 100. B. Delta T equals 100. Delta Y equals delta G equals 0. Then delta S equals 0.2 times 0 plus 0.8 times 100 minus 0 equals 80. C. Delta Y equals 100. Delta T equals delta G equals 0. Then delta S equals 0.2 times 100 plus 0.8 times 0 minus 0 equals 20. D. Delta L equals 10, MPL equals 20. Assume delta K equals 0. Then delta Y equals MPL times delta L equals 20 times 10 equals 200. Then delta S equals 0.2 times 200 plus 0.8 times 0 minus 0 equals 40. Let's now talk about how government finances interact with the loanable funds market. Budget surpluses and deficits. If T is greater than G, then T minus G is greater than 0. The government runs a budget surplus. This is also called positive public saving. If T is less than G, then T minus G is less than 0. The government runs a budget deficit. This implies negative public saving. If T equals G, then T minus G equals 0. This is a balanced budget, and public saving equals 0. How does the US government finance a deficit? By issuing treasury bonds, that is essentially borrowing from the market. Loanable funds market equilibrium. The real interest rate adjusts to bring savings and investment into balance. This graph illustrates the equilibrium in a loanable funds market. The vertical line represents national saving, denoted by S bar equals Y bar minus consumption, a function of Y bar minus T bar minus G bar. Since income Y bar, taxes T bar, and government spending G bar are all fixed, saving is exogenous and constant. The downward sloping curve IR shows that investment depends negatively on the real interest rate. As R increases, investment demand decreases. The intersection of saving and investment determines the equilibrium, the real interest rate, and the equilibrium level of investment. At this point, the goods market is in equilibrium. Output equals the sum of consumption, investment, and government purchases. Let's explore how the real interest rate R adjusts to bring equilibrium to both the goods market and the lawnmower funds market. Recall, in equilibrium, total output is allocated across consumption, investment, and government purchases. Y equals C plus I plus G. Then Y minus C minus G equals I. This tells us that national saving S equals Y minus C minus G must equal investment I. Therefore, the real interest rate R adjusts to ensure this identity holds. Now consider a decrease in saving from S1 to S2. A leftward shift of the saving curve raises the equilibrium real interest rate and results in a decrease in investment. In addition, let's examine what happens when investment demand increases. In this first graph, investment demand shifts from I1 to I2, but saving is assumed to be fixed. As investment demand increases due to tech innovation, the real interest rate R must rise to restore equilibrium. This results in a higher equilibrium interest rate, but no change in the quantity of saving or investment. In contrast, consider the case where saving depends on R. This means that as the interest rate rises, households are willing to save more. Now, when investment demand increases from I1 to I2, the interest rate still rises, but not as much as in the fixed saving case. Because saving is responsive to R, both the interest rate and investment increase in the new equilibrium. Let's check your understanding and review the reasoning behind each answer. Question number 1. If MPC is 0.6, then an increase in disposable income of $10 increases consumption by how much? Consumption increases by MPC times the change in disposable income, Y minus T. So you take 0.6 times $10 equals $6. The answer is B, $6. Question number 2. If national income is $1,200, consumption is $600, taxes are $200, and government purchases are $300. What is the level of national saving? National saving is given by S equals Y minus C minus G. You can plug in the numbers, then S equals $1,200 minus $600 minus $300 equals $300. The answer is A, $300. Question number 3. Suppose higher interest rates significantly reduce consumption. Then an increase in government purchases will have a what effect on the interest rate, and this will do what to the crowding out of investment. When the government increases spending, aggregate demand rises. This typically pushes up the real interest rate to bring investment and saving into balance. However, if higher interest rate also causes households to reduce consumption significantly, the initial rise in demand is partially offset. As a result, the real interest rate does not need to increase as much to restore equilibrium in the goods market. Since the rise in interest rate is smaller, the reduction in investment is also smaller. The conclusion is that the interest rate rises by less and the resulting crowding out of investment is mitigated. The answer is D, smaller effect on the interest rate, and this mitigates the crowding out of investment. After all, in this chapter, we explore the main components of aggregate demand, consumption, investment, and government spending, and how they determine the allocation of national income in a closed economy. Consumption depends on disposable income. Investment responds to the real interest rate, and government spending is treated as exogenous. Through the goods market and loanable funds framework, we saw that the real interest rate balances saving and investment, ensuring that total output equals planned spending. In the end, the chapter emphasizes a key identity. In a closed economy, saving equals investment, a principle that highlights the industry's role in linking savers and investors.